They're back. We are so excited to reboot our client educational meetings this past week. I just almost felt like back to normal. Granted, things are very far from normal, but I think at some point you just gotta kind of lean in and do things in as safe and as clean and as open of a format as possible. So we did that this past week, and on the show we want to recap the topic that we had, which was a pretty good one. So we're going to share it with you in detail on the program. And it really is, I guess, kind of going back to the fundamentals. The purpose of these educational dinners that we do exclusively for our clients is that in normal times, pre-pandemic, we would have one every quarter. So about every 3 months or so, we're going to have something that allows you the opportunity to maybe hear from an economist, maybe hear from someone that's got some insight into tax changes, maybe hear from a portfolio manager, investment manager, things like that. Because we think it's so important that people really understand and have some insight into what it is that they actually own when it comes to your investments and your retirement. So obviously with the pandemic, weren't able to hold those. And so back in like June, when the numbers were really getting good in terms of COVID, meaning very low, we said, oh, well, let's try and make some plans for the fall, sign some contracts, got some space, things like that. And then, lo and behold, things didn't turn as good as we expected. But fortunately, we kind of at least sort of thought it out ahead of time, because we did change a number of things in terms of, I guess this would be sort of the new normal, right? Instead of having an educational session just on one night, we're doing the exact same presentation on 2 nights, so sort of split up the crowd. And so this coming Thursday, we'll kind of redo the same event all over again, giving an opportunity for, better spacing and social distancing. And then we also went to a bigger space, and more importantly, we've had 2 bars instead of 1, so you didn't have a big line at the bars. Anyway, so new normal stuff, but it was really great to really lean in and have an opportunity to just have a somewhat normal experience, particularly when it comes to helping to educate our clients. And then for our friends that, not quite comfortable, we get it. Not everybody is quite as comfortable as everybody else. We obviously were able to do that on a Zoom basis as well. So really cool. We encourage you to check out the pictures that we posted on Facebook and LinkedIn to give you a feel and a flavor. And if you're one of our clients that is coming to this week's meeting, hey, it was a great meeting. You're going to be glad you came. And by the way, not too late to sign up, I think, maybe Tuesday. So anyway, call the office, the number, and Carolyn can connect you with the details on that. So what are those principles of long-term investing resilience that we talked about this past week? We're going to talk in great length about them, but I just think that there are always some fundamental truths, right? This program has been on the air since the late 80s, Central Florida's longest running radio program, now coming to you on, a slew of networks throughout Central Florida, whether you're joining us on 96.9 The Game, got a Bucks game coming up at 4 o'clock today, or whether you're on the News Radio WFLA Orlando, or you're over there on the Space Coast where they're launching people into space on a regular basis, normal folk like you and me. Well, assuming that you got a giant wallet. The reality is that we're happy to also be on the WMMB 92.7. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So one of the things that I've heard a lot over the course of being in the financial industry all these years, is that everybody sort of says it's different this time. I think that's a very popular expression. Hey, it's different this time. It's different this time. And I guess my response is always, well, history may not perfectly repeat itself, but it generally follows the same tune. The beat can change, if you will, but the tune remains. And certainly when you think about today's world, it is certainly a changed beat, right? Versus where we were 20 years ago. There's more information, and it comes to us in a much faster format. I mean, back in the day, you used to actually have to look to see what was going on in the world at large, and now our phones are like it turned us all into like Pavlov's dog. Like every time you hear the ring the bell or you hear the little ping on the phone, then that must be a headline, and poof, there it pops up. ESPN is really good at that, particularly on a weekend when you had so many great college football games like yesterday. Fortunately, both my boys' teams lost, Auburn and Virginia. And unfortunately for our Florida fan and Florida State fan, not a good day yesterday for the home crowd. Anyway, that kind of faster information really does lead to more noise, and more noise leads to more fear, and more fear leads to poorer investment and financial decisions. It's one of those things that that first burst on the scene in terms of the common folks. I remember, back in engineering school in undergrad, which would be more than a few years ago, probably about 30 odd years ago. I remember, seeing the internet for the first time, and it really didn't get pervasive in society, although probably, maybe even 10, 15 years ago. And so all of that, at the time, it was billed as, if you remember it was billed as, this is all going to allow us to make better decisions, smarter decisions, because we have all of the information at our fingertips, no problem at all. And then the reality sits in, and you've got more information leading to increasingly distracting information more than anything. And the other part of it is that investing has increasingly become more complex and riskier. And part of that's due to low interest rates. A lot of it's due to low interest rates. Back in the day, you could have a money market fund. I remember money market funds at 5%. You don't have that anymore. So what that means is you have to take more risk in your portfolio than what you might otherwise have had to do had interest rates been lower. That's pretty important. Those two little statistics are pretty important, and are going to set the stage for why it's important to remember these principles of long-term investing resilience that we're going to share with you in the next segment here on Dollars and Cents with Joel Garris of Nelson Financial Planning. More information at a faster pace leads to more noise, more fear, and worse decisions when it comes to finances and retirement. I think we all agree, or certainly information comes to us so much faster, so much quicker, and there's so much of it on a daily basis, much more than there ever was in our lifetimes. And the other part that is important to remember that we were touching on just at the very end of that last segment is over the course of the past 15 years, and this is related to, and we mentioned interest rates being as low as possible, particularly over the past 15 years, but also a lot of corporations ultimately using free cash flow to do share buybacks, things like that, less on the dividend side, if you will, or not as much growth in dividends as you might have expected given the profitability of some of these companies. So you've got those two dynamics, interest rates, share buybacks. And the reality is that when you look at the past 15 years and compare it to the previous 15 years, so you go back to 2006 to today, and then look at that previous period, 1991 to 2005, and you compare those 15-year sort of segments, what you'll actually find is that the portfolios today, the investment portfolios today, to get the same return, are effectively taking 3 times as much risk as what you had to do in that prior 15-year period of time. So it's certainly a pretty important dynamic to be thinking about, particularly when you're thinking about your investment allocation, your mix, things like that. And also to really be thinking about what we're going to be talking at length in this segment, which is some of these principles of long-term investing resilience that we shared with our clients at the educational dinner meeting that we had this past week. And I guess anytime you're talking about investing fundamentals, it always has to start with volatility, right? Volatility is normal. Certainly, there has been a smooth ride in the markets for the past year and a half. But if we simply look at the last 20 years and look at market changes intra-year, what you'll find is that in the past 20 years, there was at least a 5% decline in the markets in 19 of those 20 years, at least 5%. For 13 of those 20 years, that's still a majority of time, you actually saw a pullback of about 10%. And in 6 of those 20 years, going back over the past 20 years, what you'll find is a 20% decline in the market. 6 out of 20, it's not quite a third, but it's pretty close to a third. So it's important to remember that volatility is normal, and that cuts both ways, right? One of the things you have to remember is that, hey, this stuff is, any of my investments are always going to go up and down in value. But it's interesting how you go into a period of time like we've sort of had, particularly over the past 18 months, where things are relatively smooth, and it does breed complacency. It breeds this notion of, it doesn't matter what I do, I can just invest money and it's going to go up, and all of that is great. And so you may want to just stop and get some perspective and some insight on what normal times, or I guess the fact that volatility is in fact quite normal. However, let's not get too fixated on that volatility on an individual year basis, particularly the numbers we just gave you, because here's the other thing to remember, and that is, of course, perspective. So over time, bull markets, right, that's the market going up. Okay, bear markets, that's the market going down. Bull markets have, in fact, lasted much, much longer than bear markets, and ultimately have generated a much stronger cumulative return. Here's the stats. Over the course of the past 80 years, bull markets have lasted generally on average over 4 years, produced a total return of about 145.7%, give or take. And then bear markets have lasted typically around about a year on average, looking back over the course of the past 80 years, resulting in a decline of 32%. Well, I understand decline of 32%, that's not good. You're giving back a lot of the profit, but remember, the bull markets last much, much longer and generate much, much stronger returns over time. That's why when you look at the chart of the stock market over the course of the past 70, 80, 100 years, it's a gradual increase upward, a gradually sloping line that's upward. And if you look closely at the line, there's a lot of movement up and down, but at the end of the day, certainly you can see the trajectory. And that's the thing to remember in terms of that perspective, but also understand and appreciate those statistics we just gave you on volatility as it occurs on a year-by-year basis. 6 of the past 20 years had declines of more than 20% during the course of the calendar year. So understand, volatility is quite normal. Number 2, and I guess this goes hand in hand, control your emotions. Here's the stat. We've certainly said it before on the program. If you look at the past 20 years, the broad-based market, as measured by the S&P 500, annualized return of about 7.5% per year over the course of the past 20 years. If you look at the average investor during that same 20-year period of time, their annualized return only about 6%. Well, you may say, well, 6 versus 7.5, that doesn't seem that bad, except that it's 80% of what you could have gotten had you just invested and left it alone. It's 20% less than what you had. Now, stop and think about that cumulatively, right? 1.5%, and we're talking about a 20-year period of time. on a cumulative basis, that winds up being a 35 to 40% difference in how much money you have at the end of that 20-year period of time. That's a pretty significant difference. And in our view, it underscores the notion of your best way to get results is to be consistent, control your emotions, and stay invested. Now, that doesn't mean that there's not other principles, and we're going to continue to talk about them on the program, that would say, hey, from time to time, you got to look at it, you got to rebalance, you got to make sure you got a good mix, things like that. And we're going to come to a lot of those here very, very shortly to kind of recap that as well. The other concept, and so this segment, we're kind of talking about some of the I guess, the fundamental concepts. And next up on the list has to be this notion that it is time in, not timing, that matters most in terms of your investment results. Look, building wealth takes time. You're not going to get rich overnight. And if you're continually focused on getting rich overnight, I assure you, we see it all the time, you're not really going to get there because everything always falls short, and then you proceed to look at the next thing to try and make up for the thing that didn't work out. And it winds up just sort of being almost a cascading turn of events. Here's the numbers. S&P 500, if you look at this notion of time in versus timing, if you look at the S&P 500 over a 1-year period of time, you'll find that 74% of the time, it's positive return. 26% of the time, that means it's negative. If you then go out for 5 years and look at the broad-based market, you'll start to get better numbers, right? 83% of the time, if you kind of look at any 5-year rolling period, 83% of the time it's positive, and now only 17% of the time is it negative. 10-year period of time, again, 10-year rolling periods of time looking at the broad-based market as measured by the S&P 500, 92% of the time, you're getting a positive return, and only 8% of the time you're getting a negative return. And then lastly, 20-year period of time, looking at the 20-year rolling periods of time in the S&P 500, you will find that 100% of the time there is a positive return, and there's no 20-year rolling period of time in the S&P 500 in the market that had a negative result. Time in, not timing, ultimately is the greatest determinant of your investing results. So some pretty important concepts there. We'll end this segment with one more, and that is the power of compounding, often called the eighth wonder of the world. I think Dave Ramsey calls it that. And the reality is that it's how quickly your money is going to double and grow over time. So simple rule of thumb on that is going to be the rule of 72. It's a little math rule out there. You take your percent return, you divide it by, or you divide 72 by the percent return. It tells you how fast money is going to double. So, for example, if you're earning 1% on your money, maybe you're stuck it somewhere in a CD, it's going to take you 72 years for that money to double in value. If it's in a bond at 3%, it's going to take 24 years to double. And if it's in stocks, generally making about 7%, then it takes about 10 years. Which one sounds better? At the end of the day, the power of compounding works well if your underlying rate of return is good. If it's not, it takes much, much longer. We're going to take a break. When we return, we're going to continue the conversation of some of the investing principles for long-term resilience here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about some of the principles of long-term investing resilience on the program today, sort of a recap of the client educational dinner that we had this past week. So excited to be able to bring those back for our clients. Typically hold them once a quarter. Obviously, I haven't been holding them, and happy to restart those. Doing them, obviously, I guess, under a new normal where it's a bigger space. It's the same presentation over 2 nights. So we got the repeat of the event coming up on Thursday. A couple of bars to help reduce down the lines. I think people generally like that anyway. And so certainly it was a great event that we were able to kind of lean in and make happen, because we do think educating our clients about their finances, their investments, what it is that they own in the first place is always a very good thing. It leads to much better decisions in terms of having that information. And I think it's important to also talk about those kinds of concepts because statistically there's been a pretty interesting phenomenon that has been going on in America as a whole, particularly over the course of the past year. And it really does sort of, I guess, surprise people. And obviously the pandemic has an impact in it. But when you look at the statistics, it is noteworthy in terms of the amount of folks that are retiring these days is a significant increase over the typical level on a statistical basis. Here are the numbers, and this comes from the folks at Pew Research Center. Over the course of the previous 8 years, there was an average of just slightly over 2 million Americans that retired each and every year. So very normal average over the course of the past 8 years, but about a couple million people that were retiring. Lo and behold, 2020 comes along, and we see a 56% increase in that number. Number of people who retired last year, 2020, 3.2 million Americans made the decision, I've had enough. I'm done. And again, pandemic related, I'm sure that was a big factor in it. But it's interesting to see how much these numbers have really changed, how much these numbers have really skewed. When you're talking about a 56% increase in the people that are retiring, that is a pretty significant difference. And the reality is that they are retiring at a point in time when longevity is pretty decent. And so consequently, it's important to really understand some of these principles of long-term investing resilience that we're talking about on the program today, because you're going to want to follow these principles during the course of your retirement, not just get educated on them, which obviously is our goal at Nelson Financial Planning, but also make sure that you are following. So welcome to the program. We've got some more of those principles to talk about here in this segment. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Maybe it's one of those cases where you just have to have a better understanding of what it is that you own, particularly if you are going into retirement. But a pretty important statistic to sort of note, 56% increase in the folks that are retiring versus what the trend had been over the previous 8 years. So pretty important indeed. So talking about some of these principles of long-term investing resilience, you have to include diversification in there, right? I mean, that one simply has to get on the list. And it's a simple concept involving don't putting all your eggs in one basket. Applied to investing, that means a variety of things. It means don't just own a handful of individual stocks. It means owning a much broader portfolio of a wider arrangement of companies throughout your portfolio. One of the things that we look at whenever we look at the portfolios that we do at the office, we kind of do like a Morningstar X-ray type of analysis on it. And we always want to make sure that in terms of the individual holdings, there isn't a single individual holding that's more than 5% of one's total portfolio. So those are the kinds of things that's important to look at. And so from a diversification point of view, it doesn't just mean, I own this stock, that stock, or whatever the case may be. It means really looking at the details in terms of what you actually own inside any portfolio. And then to also be aware that you don't want to be so concentrated in any one particular sector. That's another thing that's sort of this Morningstar X-ray thing that we do kind of breaks down in terms of the grid, the different types of companies you can own and the different, types of approach, whether it's growth versus value. Those types of things are all things that you would look at. I mean, because here's the thing, there is still a lot, human nature, there's a tendency to chase the best performing sectors. Look no further than the fact that large cap growth has been all the rage this decade, right? It's clearly hands down the best performing sector in the market. That's the FANGs, Facebook, Amazon, Netflix, Google, Apple, all of those companies, right, are all part of that large growth piece, and they've done very, very well. But what's interesting about that large growth category is if you look back to the prior decade, it was the worst performing sector in the market. So if you're basing your decision on, hey, this stuff is doing well and I'm going to buy that, and this stuff isn't, I'm not going to invest in that, or I'm going to reduce that down as much as possible, then you probably missed out on a pretty good opportunity, particularly with respect to large cap growth. You're never going to be able to predict which sector is going to take off, so it's important to be diversified. So diversified at its simplest level, don't put all your eggs in one basket. From an investing perspective, it's about making sure that your portfolio is not concentrated in any one particular stock, and similarly that your portfolio isn't concentrated in any one particular sector. That's a little bit deeper dive on the diversification point of view, which then sort of gets us right into the notion of asset allocation, right? Asset allocation is key. And what that means is that, simply put, the percent that you've got in stocks versus cash and bonds. Why do we draw that sort of distinction? Cash, bonds, lower return, but lower risk. Stocks, higher return, higher risk. So obviously you want to sort of strike the balance, if you will, over the course of your investment portfolio, right? You don't want to be, just as you don't want to be too aggressive, 100% all in stocks and those kinds of things, you don't want to be too conservative, 100% in bonds, or because then you won't get any kind of a rate of return. There's been a lot of studies and extensive analysis done on kind of the right mix in terms of the balance between stocks and bonds versus your withdrawal rate. And so when you look at withdrawal rates, and withdrawal rates off of an investment portfolio become pretty important in retirement, because that's in essence what you're doing, right? I mean, you've got to be drawing income off of your investments, because that is the part that's generating your income in retirement. So when you look at that withdrawal rate, the way to calculate it is to look at how much you're taking out on a monthly basis, multiply it by 12, or add up the withdrawals for the course of the year. That's your annual amount. Take your annual amount, divide it by the total balance, and you'll find out what your withdrawal rate is. That withdrawal rate ideally should be 4%, maybe 5%. You start getting above 6%, you start running into issues in terms of having the account be able to continue on for the rest of your life. So that's what the withdrawal rate means. There's a lot of studies have been done on this withdrawal rate, and then relative to the mix. And what's interesting about the mix in terms of the asset allocation is that you would think, oh, well, I'm going to be fine if I am more conservative. And the reality is it doesn't actually play out that way at all. If you look at a mix that's 75% stock, 25% bonds, and compare it with 25% stock, 75% bonds, what you will find is that in all cases, 4% withdrawal rate, 5% withdrawal rate, 6% withdrawal rate, the risk of running out of money is more on a 25% bond, 25% stock, 75% bond portfolio than a 75% stock, 25% bond portfolio. So you would say, well, wait a minute, if I don't take much risk, I'm going to be okay. And the reality is, when you look at your withdrawal rates, you actually find that the likelihood of success is much better on a 75% stock, 25% bond portfolio versus a 25% bond, 75% stock portfolio. Further underscoring the notion that When it comes to asset allocation, you cannot be too conservative because the risk is actually greater on that particular case where you're taking income out of your portfolio. We're going to take a break. We come back, we're going to wrap up some of these principles of long-term investing here on Dollars and Cents with Joel Garris of Nelson Financial Planning. I want to spend a little bit more time talking about that concept we were suggesting at the end of the previous segment, and that's this notion of just how crucial asset allocation is, the differences between what you own in stocks versus cash versus bonds, and when you are taking income out. So these numbers come from a study that was done a few years back, and it looked at 30-year periods of time, which today, that's the average period of time that somebody spends in retirement, particularly if you're a married couple. One of you might very well make it into the 90s. So that notion of having that 30-year perspective is so crucial when it comes to retirement, particularly with that 56% increase in the number of people that were retiring that we were sharing with you all in the last segment. So the study looked at sort of rolling 30-year periods using 85-year historical data, looked at different withdrawal rates, 4%, 5%, 6%, and then looked at what the mix was. And so we were talking about a mix that was 75% stocks, 25% bonds. So one that would say, oh, that's, got a pretty good amount on the stock side, and then compared that with certainly the more conservative alternative that was only 25% stocks, but 75% in bonds. And what the conclusion is, particularly when you start to look at the withdrawal rates relative to the asset allocation mix, what you'll find is that you actually wind up significantly increasing your likelihood of your investment accounts lasting for the rest of your retirement by actually having the mix that's 75% in stocks, 25% in bonds versus the mix that's 25% in stocks and 75% in bonds. Bottom line, don't get too conservative with your investment just because you go into retirement. And folks, this is one of the chief reasons why we really don't like target date retirement funds. We understand they're all the rage and they're meant to be very simplistic and cookie cutter and all that. But when you start to look at real studies that have been done on investment performance and particularly getting income, those target date funds go way too early to the bond side of things, way too heavily when you start to think about that. So again, asset allocation is important. We all know that. I think that's given. But there's more to that in terms of what the right mix is depending upon your particular set of circumstances. And then this last one, which I think is a perfect one to sort of end on, this last one has sort of been a theme for us at Nelson Financial Planning pretty much during the course of this year. And that is this notion of rebalancing. And here's what happens, right? Let's say you start out with that 75% stock, 25% bond type of investment allocation. And that's what makes sense for you. You're on a growth and income approach. You're taking income out of the portfolio. And that's the original mix, if you will, or allocation that you start out with. Well, market goes up pretty well, and all of a sudden you find a year later or 2 years later or 3 years later, wait a minute, I'm not at 75% stock, 25% bonds now. Now I'm at 85% stock, 15% bonds. Poof, your portfolio now has a lot more risk to it than what you started out at. The notion of rebalancing is to fix that. Bring that back down to that 75-25 type of mix that you may have started out with. And ultimately, the other part that effectively rebalancing does is it really sort of helps to trim profit out when things are going well in the equity market. So don't forget the concept of rebalancing and make sure that you're looking at your portfolio. And ultimately, right now, we see a lot of investment portfolios creeping up in terms of the relative risk simply because the stock side has done as well as it has. And that, by its very nature, is then going to skew the portfolio more to the stock side than the bond side. Some important things to be thinking about. there. Certainly those are some great principles of long-term investing resilience that we were able to share with folks at our client educational dinner this past week. We've got the repeat of that event coming up this week, and I'm sure our featured speaker will have a much better way to sort of explain it than what we've kind of just hit in the little bit of highlights here on the radio program. Plus he also had like a bunch of slides and stuff like that that really kind of helped to make it make more sense. It's hard to get some of these concepts across on radio, but hopefully you're able to appreciate those principles of long-term investing resilience. So we will give you one more statistic that we saw this past week, and we'll end on this one. This one will, maybe leave you scratching your head for the week ahead. So here it goes. It's Social Security. We'll get our associate, Rob Field, on the program here probably in the next 3 or 4 weeks to talk about this. He's also got the latest on the COLA, and I don't want to steal his thunder a whole lot on it, but when he was on the program, and this wasn't more than 3 or 4 weeks ago, we were talking about COLA potentially at 5% in terms of that adjustment on your Social Security. There are some reports that are suggesting that it's going to be above 6%. Time will tell on that. I think it's still another 2 or 3 weeks before that final data comes out that drives how much your Social Security is going to go up. But you're gonna see a once in a lifetime increase in Social Security. That's the good news. The bad news is that it's going to get gobbled up at the grocery store and at the gas pump. Anyway, speaking of Social Security, here are the latest numbers on it. The projected 75-year shortfall in the Social Security Trust Fund has tripled in the last 10 years. The 2011 trustees report forecasted a 6.5 trillion shortfall. Boy, these are big numbers, aren't they? Right? Trillion. That's a lot of zeros. 6.5 trillion shortfall. That was the 2011 projected shortfall, projecting that over the course of the next 75 years. The 2021 report, 10 years later, released at the end of August, now projects the present shortfall to be $19.8 trillion. So a tripling of the shortfall in a 10-year period of time. Folks, they're talking about a lot in Washington. What they really should be talking about is how do you shore up Social Security? Putting aside all this other stuff, let's focus on what's going to be really important, because Americans rely on Social Security as part of their retirement, period. Anyway, we'll end with that. We're going to wrap it on up and get on out of here. Thanks for listening to the program. This is Joel Garris of Nelson Financial Planning.